Hi, this is Mark Pfeiffer, and in today's presentation, I'm going to show you how to calculate the net operating income. That is known as taking your total rents from the property, subtracting all of your operating expenses, and then you'll get to the net operating income. And the net operating income is useful for calculating things like the cap rate and also getting to things like our cash flow, before tax cash flow, after tax cash flow, and I'll get into that stuff a little bit later. But for now, we're going to go through an example here. And then at the end of this presentation, I'll give you a problem to go through and have an answer key within a Google Doc in the description of this video. So I hope that'll help you to conceptualize and really get a good understanding of this concept called net operating income. So we're going to build here real quickly a financial statement of a property, imaginary one, and it's going to have our income and expenses listed in there. So let's get right into it. We're going to assume that this property has 12 units. We're going to assume also that the rent per unit, the market rent, is going to be $1,200. And we're going to assume that a vacancy rate of 10%. So, first things first, we're going to have our gross rents. And let's make this actually gross potential rents. And that means that assuming 100% occupancy, how much rent would you collect? In this case, we're going to take the 12 units, multiply it by the current market rent of $1,200 a month, and then multiply this by 12 months to get an annualized number. We'll include other income, which will be income that is affected by vacancy. So that could be income like laundry, because if there's fewer people in your property, then you'll get less laundry revenues. So let's say that potentially the other income would be $10,000. So then we're going to get to a gross potential income number, which is the summation of those two. And from this, we would have a vacancy. Vacancy means that your property over the year, if it's 10% vacant, it means that 10% of the units over the year are not occupied. So we're going to take this number, multiply it by 10%. That gets us our vacancy. Then we can also include other income that is not affected by the rents or by the occupancy. That could be things like perhaps you have a billboard on your property, you're collecting advertising revenue from that. Perhaps you have a cell phone tower on your property, you're collecting revenue from that. So let's say in this case it's $5,000. Then that'll get us to our effective gross income, which is going to be the gross potential income minus the vacancy plus the other income that is not affected by the vacancy. And that gets us $169,520. Now we're going to go through our operating expenses. Big ones for a property are things like insurance, property taxes, maintenance, utilities. You could have other things like rent control fees. And also a big one too, if you decide to outsource the management of your property, you would have a property management fee. Let's assume in this case the property management fee is 10%. So we'll put here property management fee 10%. So then we'll take 10%, multiply that by our effective gross income. We'll assume that that management fee is based off of the effective gross income, which is good because it means that the property management company has an incentive to keep the vacancy low, the occupancy high, because they'll get more money if they can do that, because the effective gross income would be higher. For insurance, let's assume insurance $5,000 a year. Property taxes, we'll assume they are $14,000 a year. Maintenance, we'll assume that it'll be $14,000 as well. Utilities, let's do $20,000. Now utilities includes things like gas, electric, water, sewer, trash, and it depends solely on the lease whether the landlord is paying for the majority of those expenses or the tenant is paying for the majority of those expenses. So that would vary depending on the property and the lease agreement. So rent control, we'll just assume $1,000 a year. So then we'll get our total operating expenses, and that is the summation of all of our operating expenses. So we're right here, I'm using the sum formula in Excel and adding all these up. Now that we have that, now that we know what our effective gross income is and our total operating expenses, we can calculate the net operating income, or NOI. And that is calculated by taking the effective gross income and subtracting our total operating expenses. So in this case, we have it as $98,568. So to calculate the cap rate, we would need to know what the purchase price of this property is. So in this case, we're going to assume the purchase price is $900,000. So we'll call this the entry cap rate, because it's the cap rate of the property when we're buying it or entering the project. And that cap rate formula takes the net operating income and divides by the purchase price of the property. And the cap rate right there is, let me break it out, 10.95%. Now when you're looking at a cap rate, it's helpful to look at it in reference to the cap rates of other properties in your market. So if other properties that are similar to this one that we're looking at have a cap rate in the market of 6%, then that would mean that the valuation of this property at a 6% cap rate, you would take the net operating income and you would divide by the market cap rate, should be 1.6 million. So we can see how much equity we're getting by buying this property. Equity is the difference between what you have in the property. So if we paid all cash for this property, $900,000, it'd be the difference between all the money we had in there, the $900,000, and what its current market value is. So based off of 6% cap rate, the valuation would be 1.6 million. We would take that and subtract the purchase price from there. So we're getting a lot of equity just by buying this property because for whatever reason it's priced under market. So when the cap rate is higher than the market cap rate, that's a good thing, assuming that this property is comparable to all the market comps. So I hope that this has been helpful for you, and what I'm going to do now is create a simple problem for you to go through, and let me show you what it is. So now it's time to test your knowledge and see if you really got the understanding in my presentation with this example. You're going to assume a property that has 20 units. Market rents for each unit are $1,500. The other income that's affected by vacancy is $20,000. The other income that's not affected by vacancy is $10,000. And these are per year numbers here. Then vacancy rate will be 12% of your gross potential income. The operating expenses are 50% of your effective gross income. The purchase price is 1.5 million and the market cap rate is 7%. Using this information, the questions that I would like you to answer are: what is the effective gross income? What is the net operating income? What is the cap rate? What is the market valuation? What equity do you have upon buying the property? So try this yourself, get these answers, go through the process that I just described through my video, and in the Excel document file in the description of this video, I will have the answer key there for you. So I hope this has been helpful for you. Please let me know if you have any questions by posting a comment in the comment section below on the YouTube video. Have a great day.